Hey everyone, welcome back to Corporate Decoder. Today we are diving into the world of underwater robots with Nauticus Robotics. This SEC filing is a roller coaster. Buckle up because it looks like someone forgot to check their math and had to restate their earnings. We'll decode what happened, what it means for the company, and if there are stormy seas ahead. First things first, Nauticus had to refile their financial report. In simple terms, they messed up the accounting on some debt, specifically convertible debentures, which are like loans that can turn into stock. They initially used one accounting method, but realized they should have used another. It also looks like there was a miscalculation on some debt related to converting the debt to stock at prices below the conversion price. This mistake was big enough that their audit committee said, wow, we can't trust the old numbers anymore. So they had to go back and fix it all, which they call a restatement. It means all the numbers you saw before, well, throw them out the window. Alright, let's get into the numbers from their balance sheet, their financial snapshot. As of September, they had about $229 million in cash. That means they were owed nearly $400,000. They had roughly $2.2 million in inventory, which is all the stuff they are building or is ready to sell. Compare this to December, when they had only $712,000 in accounts receivable and $2.19 million in inventory. They have a bunch of underwater robots and equipment, about $16.1 million worth as of September. They also have about $1.2 million in assets for operating leases, which cover office spaces, etc. This is important because this shows that they have invested in hard assets, the tools to get the job done. Now looking at the liabilities, things get a bit more interesting. Check out their related party notes payable. They have about $53.2 million. I'll take a look at their long-term notes payable, which is around $12.7 million. It looks like they have a fair amount of debt that has to be paid off down the line. Let's move on to their income statements, which shows how much money the company made or lost. For the 3 months ended September, they made about $370,000, now compared to about $1.5 million last year. This represents a huge 77% decrease in revenue for the quarter. Looking at the 9-month period, the revenue dropped to about $1.3 million compared to $5.5 million last year. It seems they really had problems closing sales this year. Looking at the cost of revenue, it appears to be roughly similar to last year. For the quarter, the expense was $2.65 million last year. For the 9-month period, it was $7.51 million this year to $748 million this year to $748 million last year. This tells me that it's not their expenses driving the lower profit, but simply their failing revenues. General and administrative, or G&A, are all the regular business expenses that keep the lights on. Turns out those expenses dropped a lot. General and administrative is down significantly from the previous year, from $6.7 million to $2.80 $7 million. This means their attempts at cost cutting appears to be working. Because of these factors, they had an operating loss this quarter of $5.5 million compared to $8.1 million last year. However, their net income was $17.9 million the previous year. I will look at the other expenses to understand why. Interest expense also significantly increased this quarter to $1.5 million compared to only $873,000 last year. Over the 9-month period, the expense increased by over $3 million, from $7.8 million to $3.7 million wellcars. This is huge. What really drove up the profit was that they had a huge gain from revaluing new convertible debentures of over $24 million, which led the 9-month period to similarly have a positive impact of over $36 million on. Because of these factors, earnings per share significantly improved this quarter from a loss to a profit this year. However, for the 9-month period, their loss per share grew larger. Turns out that they also experienced foreign currency transaction losses this quarter. You will see an extinguishment of debt as a large expense over the 9 months because they amended and exchanged a large part of the company's debt, which I previously covered. Let's also examine their cash flow statement. Turns out their net cash used in operating activities was $20 and $8 that they used last year. Overall, their cash and cash equivalents increased, driven by financing. However, the rate at which they are burning money does not seem sustainable. They did get $14.3 million in notes payable, and from their ATM stock offering, they secured around $9.8 million. However, they spent money on new equipment. The story being told here is they are spending a lot of money to keep the business going. They also had other comprehensive losses related to currency translation adjustments. Alright, let's dive into the footnotes, which will give us more insights on how they came up with the numbers. The first thing I want to highlight is their liquidity, which is a fancy way of saying, can they pay their bills? Turns out they say they don't have enough revenue to cover their expenses, but they are cutting costs. They are relying on a current investor to continue to fund the company to keep it afloat. Keep this as mine. So why did they have to refile the financial reports? Basically, they used the wrong accounting method for a debt deal. When they did it incorrectly in prior quarters, it overstated accrued liabilities long-term notes, and it affected their net income, all of which they adjusted. Turns out these accounting mistakes are big deals. If companies don't follow the rules, it can make their financial situation look very different from reality. There are a lot of estimates that they use to get to their numbers. These estimates can significantly affect whether the numbers can be trusted or not. Stock-based compensation are things like options that are given to employees. It's very important to see and be aware of the amount of significant accounting policies that are being made. These are generally more of a grey area. To determine revenue, they estimate costs and performance, and these are hard to nail down. They value their inventory at the lower of either cost or market, so they are aware of overspending. Turns out they did a reverse stock split in July to get their stock price high enough to keep trading on the Nasdaq stock exchange. It looks like they're doing a bunch of revaluing. Some of it is at market prices, but fair bit is not. There were a number of large stock and debenture exchange offers after September, so the effects have not been accounted for yet. The company also states that should they not meet listing prices within 5 years, they have to issue share and other compensation which may be harmful to equity holders. Alright, so what's my take on Nauticus Robotics? Well, it's a tough one. The potential in their technology is definitely there. Ocean robots are a cool idea and they're trying to solve some real problems in the industry. But the business right now doesn't match the potential. Revenues are way down and there are significant liquidity issues. They are relying heavily on cost cutting and this current investor. Plus the whole accounting restatement thing doesn't inspire a lot of confidence. The significant debt also creates a lot of pressure. A lot of their stock is controlled by the debt holders. So if they have a disagreement, the direction of the company might change on a whim. The good news is that they appear to be doing everything they can to grow and increase the business's longevity and compliance with the SEC. They have reduced a lot of their liabilities. But I will closely be watching this company in the future. While their tech sounds cool, it's not clear that the business can be saved. What do you think? Let me know in the comments. Do you believe in the underwater robots? Thanks for watching. Hit like and subscribe if you like financial deep dives.